Hello and welcome to Mobile Banker BlackBerry application. This application provides comprehensive toolset for bankers, traders, equity analysts, finance professionals, and MBA students. Key features: amortization, bond, consumer finance, where we cover auto, college, and home, depreciation, forward and future, Monte Carlo simulation, option, foreign currency option, option and future, and equity index option, T-bill, time value of money. We cover amortization, comparison, estimated annual cost, interest rate, NPV, IRR, and time value. Interest rate we cover annuity, compound interest, effective annual rate, perpetuity, nominal, real, and simple interest. Valuation we cover adjusted present value, APV, beta, capital asset pricing model, CAPM, cost of capital, WACC, and WACC, weighted average cost of capital, valuation. What if analysis, yield curve. You can email us, you can call us, and more about us. Now let's take a look at amortization. Purchase price, fees, down payment, loan term, interest rate, percentage. Okay, so after we enter the data, we can actually hover over to summary. Let's say loan amount, monthly payment, loan term, total of payments, total of interest, and this is the amortization schedule: beginning principal balance, principal paid, interest paid, and ending principal balance. This is a pie chart of the principal versus interest, and this is a graph of various balances such as the ending principal balance, interest paid, principal paid, and total cumulative interest paid, cumulative principal paid. So bond, here we cover straight bond, convertible bond, and we also calculate accrued interest. So par value is 25, bond coupon is 7.25, coupon paid semi-annually, maturity is 30 years, yield is 8%. You can enter either the yield or the market price, not both. Is it convertible? Say it is no. So now let us calculate the bond. So summary: market price, current yield, fair price, bond selling at discount, yield to maturity, Macaulay duration, modified duration, dollar duration, and bond amortization schedule. It's a straight bond price, coupon, and then we present price value of a basis point for different basis point changes. So this is the accrued interest. Next coupon date is November, and the accrued interest is that. Price, how the bond price looks like over the term, and the price value of a basis point. Now take a look at the convertible bond. So in this case we say it's a convertible bond. Offer is 4. What we are is we offer a price. Current stock price is 5. Current interest rate is 0.2. Volatility is 72%, and yield is 1.1, and offer expires 2 years from now. So now let us calculate. So here the market price, current EO, straight bond value, conversion value, option value, fair price, bond selling at discount, yield to maturity, Macaulay duration, modified duration, dollar duration, and these are the various prices: straight bond price, fair price, option value, coupon, and then accrued interest. We calculate again. This is the same thing. Price, here we see the fair price, then we see the conversion value, and option price here, expiration time, and this is how the bond price looks like. So percent price value of a basis point. So we just covered bond. So consumer finance, we have auto, we have college finance, we have home. In auto we have amortization, comparison, lease versus buy, hybrid break-even point, and what if analysis. We have covered amortization before. We just briefly skim through it. So we enter the various parameters, MSRP, manufacturer's suggested retail price, sales tax, cash rebate, down payment, trade-in value, amount owed on trade-in, loan term, month, year, interest rate, paid frequency, and extra payment. So now, okay, we'll just do a quick calculation. Sales tax is 7%, title registration is $500, and cash rebate is 0, down payment is $2,000, and loan term is 5 years, and interest rate is 3.3, and say $200 extra payment. So here we are saying that we reduction in term and savings. So schedule, this is pie chart, and this is a graph. Loan comparison, we can actually compare various loans. So purchase price is 50,000. So let us see, loan term is 5 years, 5% we are that, and now let us say 6 years and 6% we are at that. Let's calculate. So you do comparison. We know the various values here. So loan term, principal, rate, payment, total interest, savings, loan, how the payments compare, and how the payments, total payments versus total interest actually compare. So we covered auto loan comparison. Let's take a look at the lease. So using these, you can actually find out the lease payment if you specify the money factor or interest rate, and you can also find out money factor if you specify the lease amount, lease payment amount. Okay, lease versus buy. Here you can actually compare a lease and buy, which one is going to be better for you. Hybrid break-even point, here what you are doing is you can calculate the miles at which a hybrid non-hybrid car will break even, or at a point the gas price where they will break even. What if analysis, what we do here is, once one of these four variables, principal, loan term, interest rate, payment is specified, the out of the four, if three are specified, it is going to calculate the other four, the fourth one. Say 5 years, 5 interest, we come up with that. So now 698.23, let's see, interest rate. So we want to calculate the interest rate. So now, so we know the interest rate is 5% and the year, so it takes that much. So we don't know all that, so how to calculate the principal. Okay, so we covered the auto loan. Now consumer finance, you can consolidate the student loans, especially the federal student loans, and you can also amortize. A comparison that we have seen before. What if analysis, we have seen this before. In case of home, we calculate the affordability, amortization, APR, balloon payment, comparison. That's something we have seen before. Loan cost, duration, qualification, and we can also perform what if analysis. So affordability, if we specify some of these criteria as a income and other parameters, so we calculate how big of a house we can afford. So qualification based on the income, so what will be the house price requirements. Depreciation, through this we cover straight line, production or use, declining balance, sum of years digits, MACRS, and we will do one of them here. So straight line, then asset value is 6,000 and asset life is 4 years and 1,000. So what we do, we calculate, and here we see the schedule, and then we see the graph of the various balances. Forward and future, here we cover forward, index, currency, commodity. So 98, expiry rate is 0.292, delivery price we will say 3 months, and okay, so now we say what date we are going to deliver, say next year, and we do calculate. So price, parity, and etc. So if we do 99, we calculate, this is what we find. Monte Carlo simulation, we can perform Monte Carlo simulation. Say 223 days, initial value is 90, 0.005800058 is the daily average, standard deviation 0.01166. We added that, and now say that and this, and we added that. Now we calculate, so we see the price graph. Okay. Options, we cover foreign currency, option and futures, stock equity index. So we'll cover stock, and let's cover the stock or equity index. So 3.47 is our price, strike price, interest rate is 0.292. Say from 2 years from now, you can either enter the date, or you can actually select. Volatility is 72%, 1.1. Now let's calculate. So we see price and Greeks. Implied volatility we can actually calculate, and then payoff charts, T-bill. So days to maturity, price is 98, and so we see yield, that's a lot, 99. So this yield is okay. And time value of money, we have amortization, comparison, we have seen those. Estimated annual cost to compare the machine costs. Interest rate, we cover annuity, compound interest, effective annual rate, perpetuity, nominal, real, simple interest. NPV, IRR, we can calculate NPV or IRR. Here the cash flows can start at any time, and we can repeat the cash flows. So time value, specify some of these values, and we can calculate present value, future value, payment, interest, time. And valuation, here we do adjusted present value calculation. We do beta, we both do unlever, and then we relever the beta. CAPM, capital asset pricing model, and weighted average cost of capital. And then we also do a valuation using WACC method. What if analysis, this is something we have seen. And yield curve, so we fetch the data from US Treasury and draw the plot. So you can actually pick up a date and see the yield curve for that particular date. Okay, so let me walk you through little more of time value. So interest rate, so annuity 700, and interest rate is 2%, sorry 5%, growth is 3%, period is 40 years. So that's the calculus. If it is an advance, this is how it is going to be. Nominal, real, so inflation 3, nominal is 2, so you want to know the real rate. Perpetuity, cash flow, interest rate is 3%, that's perpetuity. If it's a growing perpetuity, this is what it becomes. Effective annual rate, so interest rate is 5, so we are compounding annually. That's if it is compounds on a weekly basis, this is what it becomes. If it compounds on a monthly basis, this is what it becomes. If it is continuous compounding, this is what it becomes. Okay. With this, we have covered the functionalities of amortization, bond, consumer finance, depreciation, forward future, Monte Carlo simulation, option, T-bill, time value of money, valuation, what if analysis, yield curve. For more details, visit our website businesscompassllc.com. Thank you. This is the BlackBerry amortization application, we enter the purchase price, then taxes and fees optional, down payment that is optional, loan terms, a loan term is 5 years, interest rate is 3%, it's paid monthly, and this is the summary, this is the schedule, serial number, date, beginning principal balance, principal paid, interest paid, ending principal balance. This is a pie chart of the principal and the interest, and then the graph of the balances over time, ending principal balance, interest paid, principal paid, cumulative interest paid, cumulative principal paid. And now let us add some more taxes and fees, and down payment, say it's 20%. So now we see that the loan amount is reduced because you made a down payment. Schedule, pie, and graph. Then next what we'll do is we can actually change the frequency from a monthly to bi-weekly if that's what is needed. Okay, and then we can also change the payment day, start date. So here we are saying December. When you go to schedule, that's where the date starts from. So now let us say we are making some extra payments per month. So what will happen, it will give us some savings, as we see here. It will also reduce the loan term by certain time. So here again we were making payments on a bi-weekly basis, and we total number of payments is 70, and we saved the loan term by 2.3. If you want to email the result, you can actually email to yourself, or whoever you like to, and then subject is amortization, and you can actually do that. Okay, and now we just covered the BlackBerry amortization application. Thank you very much. The bond BlackBerry application calculates straight bond, convertible bond. It calculates accrued interest. So let us first deal with a straight bond. Say par value is $25 and the coupon rate is 7.25. Coupon paid semi-annually, but you can also change to whatever frequency you would like to, and maturity is matures in 30 years. Again, you can specify the unit. Say current yield is 8%. Either you have to specify the current yield or you have to specify the market price. Then whether the bond is a convertible bond or not. In case it is a convertible bond, you have to supply few other data points. So now let us calculate the straight bond data. So summary, we have market price, current yield, fair value, bond selling at discount, yield to maturity, MACRS duration, modified duration, dollar duration, and then this is the bond amortization schedule. So straight bond price, coupon, how it is paid, and then what we do is we present you the price value of a basis point. So we go from 1 to 500 basis point, and we calculate the volatility, and then accrued interest. So if the next coupon date is in November 14th, a month from today, what will be the accrued interest? Then the bond price chart over the term, and then price value of the basis point. So now let us consider the case for a convertible bond. So let us say the price offer is 5 and the price is, so price is $5, and we are receiving 4. So as far as the offer is concerned, you can enter a ratio or a price. Here we are saying price is 5, so the number of shares will be determined based on the par value, and the stock price is 4. Interest rate, which is risk-free interest rate for the matching duration, is 0.292, and say volatility of the stock is 72. So yield, which is annual yield percentage, that is 1.1, and this offer expires actually 2 years from today, so which is 14th November 2013. So now we actually calculate. So let's see what happens. Summary. Here we have Again, we see the straight bond value, conversion value, option value, fair price, discount, yield to maturity, Macaulay duration, modified duration, dollar duration. This is the bond amortization schedule. We see the option value, accrued interest we can accordingly calculate, and then the bond price chart. Here we see fair value. This is the expiration date, and then the par, straight bond value, conversion value. The green portion is conversion value, and here the option value. This is the price value of a basis point. So with this, we just covered the bond application, which calculates the straight bond value, convertible bond price, the bond volatility, accrued interest, and provides you different charts. Thank you. Consumer finance offers calculations and analysis for auto, home, and college. On auto, it provides auto loan amortization, comparison, lease versus buy, hybrid break-even point, what if analysis. For college, it provides loan consolidation and amortization, comparison, and what if analysis. For home, it provides functionality on affordability, amortization, APR, balloon payment, comparison, cost, duration, qualification, and what if analysis. Auto loan BlackBerry application covers auto loan amortization, comparison, car lease versus buy, hybrid break-even point, and what if analysis. Amortization, say MSRP, sales tax, title registration, this is optional, cash rebate, this is also optional, down payment, this field is optional, trade-in value, this field is also optional, amount owed on trade-in, this is optional, loan term, either it can be specified as months or years, say 3 years, interest rate 3%, and payment frequency can be selected from here. We'll leave it at monthly. If you would like to make any additional extra payments, please supply that. Now move over to the summary. It says the loan amount, monthly payment, loan term, total of payments, total of interest, number of actual payments, savings, reduction in term, monthly principal, and interest. You can actually email this data to yourself or whoever you would like to. Similarly, loan schedule, serial number, date, beginning principal balance, principal paid, interest paid, ending principal balance. This is a pie chart of the interest versus the principal. This is the graph of various balances, ending principal balance, interest paid, principal paid, cumulative interest paid, and cumulative principal paid. And you can actually change the start date of the loan payment if you like. Okay, loan comparison, you can compare 2 or more loans. So okay, let's say 5-year term, 5%. This is the first loan we added. 6 years, 6% we added that. Now you calculate what we see. This is the net result of comparison. Then payment graph, how the payments compare. This is the total payments versus total interest, how they compare. Car lease, so MSRP is 24,600. Say the base cap cost, that is the negotiated price, is 23,000, and say down payment, there is a trade-in credit 5,000, and say residual percentage is 60% on the lease, money factor say 9%, lease term is 36 months. So now let us calculate the lease payment. Okay, this is the lease payment. So now let us say we know the lease payment. We would like to understand what is the interest that we are being charged on, or money factor we are charged on. Okay, so that's what we received, 9%. Okay, so lease versus buy. So again, 24,600, and this is 23,000. This is the negotiated price. and your trade-in value is 5,000, and you have a residual value of 60%, say is 3% loan, and the money factor is 9% interest, so 36 months. Okay, this is how they compare monthly payments, loan versus lease. This is actually total payments. Okay, so hybrid break-even point. This one actually allows us to calculate the unit fuel price or miles driven at which a hybrid and non-hybrid car will break even. 37,000. Sorry, let us calculate the gas price first or fuel price first. So 30,000. Tax incentive or hybrid. Fuel efficiency 45, fuel efficiency 32, miles driven, so 12,000, say 1, 2, 3, 4 and 5. So now we're going to add maintenance fee. So 500, this is 700, 1, 2, 3, 4 and 5. So discount rate is say 5%. Now we want to calculate the fuel price. And this is what it is. So now let us say we clear up all these and say fuel price we supply $4, MSRP is 37,000, that one 30,000, tax incentive is 2,000, fuel efficiency is 45 and 32 again. Miles driven we want to calculate. Actual maintenance car is 1,000 and this is 700. 1, 2, 3, 4, 5. So discount rate is 5% and we want to calculate the miles driven. So this is how many miles we have to drive for them to break even. So what if analysis? So if 3 of the 4 variables, principal, loan term, interest rate and payment are supplied, it will calculate the fourth one. 5 year and 4%, so 8, 35, 42. So you want to calculate loan term, this you want to calculate. So we know the loan term, we want to calculate the interest, this is also calculate. So we know all that, so you want to calculate the principal. This is how we calculate. Okay, with this we just covered auto loan BlackBerry application, auto loan amortization, comparison, lease versus buy, and hybrid break-even point. Thank you. College Finance BlackBerry application allows the user to consolidate and amortize student loans, compare student loans, and perform what-if analysis. Amortization and consolidation. Let's say one loan amount is 70,000 at 5%. Say we consolidate that. So we add another loan at 60,000 and at 6.3%, 2%. So now we have 2 loans. So now say we are going to pay it over 25 years and no extra payment. So term can be specified in months or years, payment frequency can be selected from here, and payment start date can also be specified. Let's say we calculate. This is the loan amount, monthly payment, loan term, total of payments, total of interest, monthly payment. If you would like to email the result to yourself or anybody else, so click on email result, and schedule. This is the amortization schedule. This is a pie of the principal and interest, and then this is the loan balances over time. Now comparison, and compare 2 or more loans, say 37,000. Here loan term is 5 years and 5% interest rate, so that we want to compare against 6 years and 6% interest rate and see how this is the summary. graph of the comparison of two payments, and this is the graph of the total payment versus total interest. So now, okay, what if analysis. This allows you to calculate one of the four variables when three other variables are supplied. So principal is 37,000, 5 is term, and this is the interest, this is the payment 664.84. say we supply that. We want to understand what the interest rate is, and that's what we want to find out what the loan term is, and that's the loan term. So we have all the data, so we want to calculate what is the principal balance, and that's what we get. So we just covered student loan consolidation and amortization, comparison, and what if analysis. Thank you. Home finance BlackBerry application covers affordability, amortization, APR, balloon payment, comparison, cost, duration, qualification, and what if analysis. Affordability. Income is 100,000, monthly debt payment is 500, down payment is 100,000, property tax rate is 3%, and home insurance is 0.3%, and interest rate is 5%. Let's see what we get. So we can saying that home value is 353,000, loan value, monthly payment and interest, property tax, then down payment and loan to value and loan amount. Okay, how much of a loan can we obtain based on the income. So amortization, purchase price is, down payment is 20,000%. We can also specify actual dollar amount. Then closing cost is 15,000, insurance is 1,500, and home, we don't have a home insurance, homeowners association fee to pay, but property tax is 15,000. Say interest rate is 5.375%. Payment start date is today. So this is the okay monthly payment. Okay, down payment is 20%, closing cost, insurance, association fees, annual property tax. Okay, sorry, we okay 30 years now. Let's see. Okay, we have all the details, and then we have loan schedule, amortization schedule. This is the pie chart, and this is a graph. Okay, loan APR, say 575,000, loan term is 30 years, interest rate is 5.5%, and points is 1%, and the closing cost is 15,000. In that case, this is what the APR is. Balloon payment, say 575,000, down payment is 20%, closing cost is 15,000, loan term is 30 years, interest rate is 5.375, extra payment is 200, and balloon payment after 5 years. So see, this is the monthly amount, balloon payment, this much how to pay, and then the schedule. Okay, okay, comparison. You can compare two or more loans. So here loan term is 30 years and 5%. After that, loan term is 20 years and 4%. So we add that. Now we calculate. So comparison, payment graphs, total payment versus total interest. Now loan cost, so 575,000, loan term is 30 years, total interest is 5.5, APR is 5.375. We want to find out the cost, and that's the cost involved. Duration, so how long will it take us to pay off the loan? 575,000, down payment is 20%, closing cost is 16,000, say interest rate is 5%, loan term say is 30 years, but we are making some extra payment. So it tells us that reduction in term is 4.5. So now we delete all that, and loan term is here, payment is 500, okay, per month. And now see, so the loan term is this, okay. And now qualification: monthly principal plus 2,000 bucks, property tax annual is 15,000, insurance is 1,500, monthly debt payment is 200,000, and property price is 400,000, down payment is okay. Now let's calculate. So this is what we get. This is the qualifying income. What if analysis? We can calculate one of the four variables when 3 are supplied and 5 years, 30 years, and say 5%. That's the payment. So 3086.72. So we want to calculate the interest rate. We found that we have interest rate. We want to calculate the duration. Okay. So we want to calculate the principal amount. That's what we get. Okay, with this we covered affordability, amortization, APR, balloon payment, comparison, cost, duration, qualification, and what if analysis. Thank you. Depreciation BlackBerry application covers straight line depreciation, production or use depreciation, declining balance, sum of years digits, and MACRS. That is modified, accelerated rates schedule. So let us start with straight line depreciation. Here we're saying the asset value, say, is 5,000, asset life is 5 years, and salvage value is 1,000, and now we actually going to calculate the straight line depreciation. So here we see the depreciation schedule. This is year, beginning book value, total depreciation cost, depreciation rate or expense, depreciation expense, accumulated depreciation cost, ending book value. And the graph, these are the various graphs. So we have ending book value, that's falling, and your accumulated depreciation expense, that is going up. So similarly we can change this to declining balance. So if you select this to declining balance, what we have, let's calculate it. So let's just, this is how it looks like, the schedule and then the graph. Now let us change this to a sum of the years digits. Okay, so this is how it looks like, schedule. This is the schedule, and then this is the graph, schedule and the graph. Okay. Now let us consider a production or use method. Okay. So here, production or use, basically we're going to add the production units, say 500, and we added first year, say 400 the 4,000 the second year, and say 3,000, and that repeats for the next 3 years. So we added all those. So and let us say 50,000 is the asset value, 10,000 is the salvage value, and we are going to calculate schedule 1 2 3 4 5, and this is the rate, and this is the graph. So now let us consider the IRS method of depreciation, MACRS. So here there are multiple property classes. Let us pick up a industrial steam engine, so we can select either it is a GDS or it is a ADS method. In this case we have selected ADS, so we can say starting month, say August. So it will ignore the value that is supplied in repair in the production and use. So this is a $5 million case. We're going to do 50 million, 1 2 3, the asset life will be automatically calculated, and salvage value will also be automatically calculated. Now let's calculate the MACRS depreciation. So this is what we find, 16 years, and this is the graph, how the graph look like. So beginning, the ending book value, and this is how the depreciation expense, accumulated depreciation expense, and this is what the depreciation schedule is for the 16-year life. So if you want to email the result, again you supply the to and the subject, then you can send. Okay, with this we covered depreciation functionalities, straight line, production use, declining balance, some of the years digits, MACRS, and for MACRS you have to select the property class, ADS or GDS, and that's how we do it. Thank you very much. Forward and future. BlackBerry application calculates forward or future. It calculates three types of future securities: index, currency, commodity. It calculates the price, value, and parity rate, which supply the spot price, risk-free rate, or a combination of delivery price, dividend or storage cost, whether it's actual or percentage, payable in months, maturity in months, or we supply purchase date and delivery date. Now let us perform one calculation. So we are doing a forward calculation, and here risk-free rate is 5% and the maturity is 5 months. So we're calculating. So price and value and parity rate. Okay, now let us do a different one. So say 60.50 and the risk-free rate is 6%, delivery price is 61, maturity is 10 months, and we paying, there is some storage cost which is 0.5, which is actual in this case. So we are calculating. So you see value and parity rate. Let us calculate an index. So index is 1103.30, risk-free rate 4.2, and maturity is in 3 months. Now let us calculate. So this is the forward price. This is the price. Say we are paying a dividend yield of 3.3%. In this case 3.3, this is a dividend yield. Okay, and now let us clear up everything. So you go to currency, so 1.7830, risk-free rate 1.5, maturity in 3 months, and in this case we have a repo rate or a dividend which is 4.75. Okay, and this is what the calculation is. Okay, now clear all this. Let's take a look at a commodity. Here 843 is the price, risk-free rate is 1.5, and your maturity in 12 months, and we are paying an actual cost of 6.8 every year. So now calculate value and parity rate. With this we just covered forward and future BlackBerry application. Thank you. Monte Carlo simulation application simulates security prices. So the inputs to this application are the trading days, initial value, natural log of daily averages, and natural log of daily standard deviation. So let's say the trading days is 223 days, initial value is 92, and the daily average is 0.0005A9, and daily standard deviation 0.0 117. So we added that is the first series, and now let us make slight change to that. So 60 for example, and we make it 2. So that is the second data point we added. Now we press simulate and let us see. So this is the price simulation for the data we just entered. So with this we just covered Monte Carlo simulation BlackBerry application. Thank you. NPV IRR BlackBerry application calculates NPV and IRR. The key advantage of this application is that the cash flow can occur at any time, cash flow can repeat, and the interest rate for individual periods can be supplied. Let's start with a IRR. So minus 5,000, minus 5,000, then we added 600, so 700, and now we say 900, and say this cash flow is repeating 6 times. So we added all those cash flows. Now we calculate IRR. So it's based on APR. It's also provides us a continuously compounding IRR. So now clear up all those. Now say 7,000, say cash flow occurs at half of the year instead of beginning, so we added that. And now so say 700, and it actually going to start from the next calendar year. Say it repeats for 10 times, so we added that. So now we calculate IRR. So let us add some more value to it. 900, yeah, so okay, we are there. So now we see the IRR. So let's clear up all let's calculate PV. So for the PV, the cash flow typically starts at period 1 instead of period 0. For IRR, the cash flow starts at period 0 instead of period 1. But you can actually specify at what time the cash flow occurs to change the IRR timing, beginning IRR timing from 0 to anything else you would like to. Similarly, for NPV, the traditional the cash flow starts at end of the period or period 1, but you can also change that to whatever you would like to. So we saying 5,000, so now say interest rate is 5%, so we added that. So now we another is 700, saying so same interest rate. So now NPV, so we got the NPV of that. So now let us we add one more cash flow at 7% interest rate. Okay, so that is basically what we did here. So here we have seen how this particular app can be useful. It is provides you flexibility in terms of specifying the interest rate in case of NPV, and it provides you flexibility to enter the cash flow timing and cash flow repetitions to calculate the IRR and NPV. Thank you very much. Option BlackBerry application covers foreign currency option, option on future, and stock or equity index. So we'll start with stock or equity index. So the input, prices and Greeks, implied volatility and payoff. Stock price, we enter stock price, strike price, interest rate, that's the risk-free interest rate for the matching duration. An expiration date can be entered two ways. One is enter expiration date. You can enter expiration date or select expiration date. If you select an expiration date, then you can actually select an expiration date from here. So we are going to select the expiration date. Say 2 years from now, volatility is 72% and dividend yield is 1.1%. And now let's calculate. So we calculate. So this is the price and Greeks. On the top we have the option price, European, call and put price, American call and put price. We have intrinsic value, time value, intrinsic value, and time value. And then we have Greeks. We have Greeks for call and put both. We have delta, gamma, theta, vega, and rho. Implied volatility. So here we see the call option is selling for 94 cents. So now say the call option is selling for $1. So then 75% is volatility for European option and 70.57 for American option. So here the put price is 2.51. Say this is 2.51 and this is a put price. So this is the volatility for the European option and the American option. So now let's take a look at the payoff charts. What we have here is we have the call profit, the red line. We have the cover call profit, the yellow line, put profit, the orange line, and we have protective put, and this is the strike price. So we cover the stock option. Similarly, let's take a look at the foreign currency option. So 3.47, we have strike price is 5, domestic rate is 0.292, foreign rate is 1.1, and we say enter the date. We say 2 years. You can actually select a year, month, or day. So we are sticking with year in case, and volatility is 72%. So now we look at the option prices. Greeks, in addition to rho, we are also calculating rho 2, which is the sensitivity of the options to the foreign interest rate, and similarly we have implied volatility and the payoff charts. And let us take a look at the option on future. In this case we have the future price and the strike price, the interest rate for the matching duration, and we pick up the date, and now volatility is this. So calculate maturity required. Sorry, we should have done that. Okay, now you see the prices and which implied volatility and payoff charts. So with this we covered option, BlackBerry application, foreign currency option, option on future, and stock or equity index. Thank you. T-bill BlackBerry application calculates T-bill price, yield, and bond equivalent T-bill yield. So let's say the price to maturity is 60 days and the discount rate is 9%. So the price of the T-bill is $98.50. Okay, say the price of the T-bill is $98.45, and we are going to calculate the yield. So we are almost getting 9.44. So now let us calculate the T-bill equivalent yield. So in this case T-bill equivalent bond yield is 9.26. So what we just covered, we covered T-bill price, yield, and T-bill equivalent bond yield. Thank you very much. Time value of money BlackBerry application provides functionalities for amortization, bond comparison, effective annual cost, forward and future, interest rate, NPV, IRR, T-bill, time value, what if analysis, yield curve. So under the interest rate, it performs annuity, compound interest, effective annual rate, perpetuity, nominal, real interest rate, and simple interest. Valuation BlackBerry application calculates adjusted present value, beta, CAPM, cost of capital WACC, and WACC valuation. So adjusted present value, what we do is we enter pre-cash flows, and we can specify the time the cash flow occurred, or we can leave it, it will start from 1, and then cash flow repeat. If the cash flow repeats, we can also specify that instead of manually entering those. So we added one cash flow, say we adding the second cash flow and we add the third cash flow. Okay, RA is a 5%, present value of financial distress 3,000, and present value of tax sale say 4,000. So we added all those and now we know the APV, adjusted present value. Beta, using this we are able to on-lever asset beta and re-lever the leverage to come up with the equity beta. So asset beta is, for example, 0.8, debt beta is 0.9, 0.7, and tax rate we're leaving the 35%. So leverage here is 80%. We added that, so that is one set of data. The second set is 0.7 and 0.6 and 70% added. So we are adding one more data set, say 0.5, 0.4 and 60%. So we added three data sets. So this is the average is 0.463. And now we want to re-lever. So we can either enter the debt or equity or leverage. So we are entering the leverage. Tax rate is 35%, beta is 0.8, and now re-lever. So this is the equity beta. CAPM, capital asset pricing model, risk-free rate 0.292, beta is 0.8, MRP 7.2, that is market risk premium, CAPM is 6.05, and weighted average cost of capital. We enter the risk-free rate 0.292, beta, MRP, all three, or we enter RE. Say in this case we're going to enter RE instead of, say, RE is 7, RD is 5, and we know the leverage 70%, and then this is the cost of capital. What we can also do is we can also enter the risk-free rate, beta 0.8, MRP is 7.2, and we can enter RD, which is 6 in this, as either we can enter the debt or equity or leverage. So we enter the debt and equity. Okay, so this is the cost of capital. The WACC valuation, here we enter the this weighted average cost of capital valuation. We enter the horizon period, so horizon period is 5 years, and then the interest rate or the discount rate is 7%, free cash flow is 5,000, and we keep adding free cash flows. Okay, let's say the terminal value is 9,000 and debt the debt at hand is 1,000 and cash is 2,000. So now this is the WACC value. Okay, with this we covered valuation BlackBerry application, we covered APV, adjusted present value, we covered beta, on-levering, re-levering beta, CAPM, then WACC for cost of capital, and WACC for valuation. Thank you. What if analysis BlackBerry application computes one of the four variables provided three of the variables are supplied. The four variables are principal, loan term in year, then interest rate, percentage, and payment. Let us calculate the payment on a 5-year and 3% loan, so that is the payment. So now let us say we have 664.84, we have the payment, we want to calculate the interest, so that's very close. So now let us say we have the interest, we want to calculate the term. So now say we have all these, we want to calculate the principal, and this is what we get. So we just covered the functionality of what if analysis. Thank you. This application is US yield curve application for BlackBerry. So let's click on fetch US Treasury yields. What it does, the application is making a trip to US Treasury and it's fetching all the Treasury data and plotting a curve, which is a yield curve, yield versus time to maturity. So what we have here, we have the various dates for which the yield data is available. Say for 10th of November, that is how the data was, and 14th of November, and the 11th of November actually was Veterans Day, so no treasury yield was available for that particular day. So as you can see, using this you can actually plot the yield curve. Thank you very much.